does losing just $100 in trading feel like a punch straight to the gut, while winning the exact same amount barely registers? You sit there staring at that red number on your screen, and suddenly your chest tightens, your palms sweat, and every rational thought you had 5 minutes ago completely vanishes. But when you win that same $100, you shrug it off, close the tab, and move on like nothing happened. Why is that? Why does the pain of losing feel so much heavier than the joy of winning the exact same amount? This isn't a coincidence. This isn't weakness. And this is definitely not something that only happens to new traders. This happens to everyone: beginners, experienced traders, and even institutional investors managing millions of dollars. And if you don't understand why it happens, it will silently drain your account one emotional decision at a time. Here's the truth that most trading channels won't tell you. Behavioral finance research has confirmed that the pain of losing is psychologically twice as powerful as the pleasure of winning. Twice. That means your brain is literally working against you every single time you face a losing trade. It's called loss aversion bias, and it is, without question, the single most destructive force in a trader's career, more damaging than a bad strategy, more costly than poor risk management, and more dangerous than any market crash. Welcome to Stick Trader Mind. Today, we're pulling back the curtain on exactly how this bias works, why it affects every trader regardless of experience, and most importantly, how to permanently neutralize it before it does any more damage to your account and your confidence. Stay with me, because what comes next could completely change the way you trade forever.
So let's get into the science, because this isn't just a feeling. This isn't just you being emotional or undisciplined. What you experience every time you face a losing trade is a deeply rooted psychological response that has been studied, measured, and confirmed by some of the most respected researchers in behavioral finance. In the 1970s, two psychologists, Daniel Kahneman and Amos Tversky, conducted a series of groundbreaking studies on human decision-making. What they discovered was startling. When given a choice between a guaranteed outcome and a risky one, people consistently made irrational decisions, not based on logic, but based on the fear of loss. Their research gave this phenomenon a name: prospect theory. And at the core of prospect theory sits one devastating conclusion: losses are felt approximately twice as intensely as gains of the exact same size. This work was so significant that Kahneman was awarded the Nobel Prize in Economics, not for discovering a theory, but for proving that human beings are fundamentally irrational when money is on the line. Now think about what that means for your trading. Every single time you open a position, your brain is not operating on a level playing field. A $200 win produces a certain level of satisfaction, but a $200 loss? Your brain processes that with the same emotional intensity as a $400 loss would rationally feel. You are fighting a psychological imbalance on every single trade before the market even moves a single pip or point in either direction. And here's where it gets even more concerning. This bias doesn't weaken with experience. It doesn't fade as your account grows. It doesn't disappear after a winning streak. Without deliberate awareness and structured discipline, loss aversion bias stays with you permanently, quietly influencing every exit, every entry, and every decision you make at the screen. The market operates on pure probability and price action, but your brain operates on pain avoidance. And until those two systems are brought into alignment, consistent profitability will always remain just out of reach.
Now let's talk about something every single trader in this space has lived through personally. Because no matter where you started, no matter what market you trade, no matter what strategy you follow, this pattern has touched your journey at some point. And if you're being completely honest with yourself, you'll recognize every single stage of it. It starts with the first win. Price moves in your direction, your account balance ticks upward, and for a brief moment, everything feels effortless. The strategy works, the analysis was correct, the market rewarded you. And that feeling, that rush of validation, is unlike anything else. Your confidence builds, your excitement grows, and quietly, without even realizing it, You begin to believe that this is how trading always feels. This is the honeymoon phase, the period where the market feels predictable, opportunity feels endless, and risk feels manageable. Everything looks green and the future looks bright. Then comes the loss. Not a demo account loss, not a paper trading simulation. Real capital, real money, gone. And in that single moment, everything you thought you understood about trading gets completely shaken. The screen that once showed opportunity now shows danger. The strategy that once felt reliable now feels broken. The confidence that was building just days ago now feels like it was nothing more than blind luck. One losing trade doesn't just hurt financially, it hits your identity. It makes you question your judgment, your ability, and your entire decision to trade in the first place. And this is precisely where loss aversion bias takes full control. Because instead of processing that loss as a normal part of trading, which it absolutely is, your brain treats it as a crisis. Rational thinking slows down, emotional decision-making speeds up, and the next move you make is no longer based on your strategy. It's based on pain. It's based on the desperate need to make that loss disappear as quickly as possible. And that is where the real damage begins.
So the first loss has hit, the emotional response has kicked in, and now here's where most traders make the mistake that truly deepens the damage. Because it's not the loss itself that breaks a trading account, it's everything that happens immediately after it. The first thing loss aversion bias does is distort your relationship with winning trades. Suddenly, every open profit feels fragile. Every green position feels like it's one candle away from reversing. So what do? You close it early. You grab that small profit and you tell yourself you're being disciplined. But deep down, you know the truth. You didn't exit because your strategy told you to. You exited because your brain couldn't handle the thought of watching that green turn red. You chose the comfort of a small guaranteed win over the possibility of a larger planned one. And in doing so, you've already broken the most fundamental rule of profitable trading. Let your winners run. But that's only half of the trap, because while winning trades get cut short, losing trades get treated in the exact opposite way. A position moves against you. The logical response is to respect your stop loss and exit cleanly. But loss aversion bias refuses to accept that outcome. So instead of closing the trade, you hold it. You move the stop loss further away. You tell yourself the market will reverse. You search for any reason, any confirmation that justifies staying in a losing position just a little longer. And that manageable loss that could have been closed at $50 quietly grows into $200, then $500, then an account-threatening drawdown that changes everything. This is the trap in its purest form. Winners get cut short, losing trades get extended. And the longer this pattern continues, the more the account shrinks. Not because the strategy failed, but because psychology completely overrode it. The market didn't take your money. Loss aversion bias handed it over willingly. And until that cycle is broken with full awareness and deliberate discipline, it will repeat itself endlessly, regardless of how good your setup actually was.
Now, here's the part that genuinely surprises most people when they first hear it. Because up until this point, you might be thinking, okay, this makes sense for beginners. New traders are emotional. New traders don't have experience. New traders haven't developed discipline yet. But surely someone with years of screen time, hundreds of hours of chart analysis, and a proven track record is immune to this bias, right? Wrong. Completely wrong. Loss aversion bias does not discriminate based on experience. It does not weaken as your account grows. It does not fade after a profitable month or a successful year. Some of the most experienced day traders, swing traders, and professional fund managers in the world have openly admitted to falling victim to this exact psychological trap. Not once, not occasionally, but repeatedly throughout their careers. Because here's the reality that nobody in this industry likes to acknowledge. Experience gives you better strategies. It gives you sharper analysis and faster pattern recognition. But it does not automatically rewire your brain's response to financial pain. That requires something entirely different. Think about it this way. A certain
surgeon with 20 years of experience still feels nervous before a high-risk procedure. A professional athlete with a decade of competition still feels pressure in a decisive moment. Experience manages the response. It doesn't eliminate it. And trading is no different. The difference between an experienced trader and a struggling one isn't that the experienced trader no longer feels the pain of a loss. It's that they have built deliberate systems and habits that prevent that pain from influencing their next decision. Without those systems, without a structured framework that separates emotional response from trade execution, even a trader with years of experience will hold losing positions too long, exit winning trades too early, and repeat the same destructive cycle that loss aversion bias creates. Experience alone is not the cure. Awareness combined with structured discipline is. And that distinction is everything when it comes to long-term consistency and profitability in any market you trade.
So after everything we've covered, the science, the pattern, the trap, the fact that even experienced traders aren't immune, you might be sitting there wondering, is there actually a way out of this? Can loss aversion bias genuinely be overcome? Or is this simply the permanent reality of trading that every participant just has to accept and survive? The answer is yes, there is a turning point. But it doesn't come from a new indicator. It doesn't come from a better strategy. It doesn't come from switching markets or increasing your screen time. It comes from a single shift in perspective that completely changes how you relate to losing trades forever. Here it is. A loss is not a failure. A loss is not a reflection of your intelligence. A loss is not the market punishing you or working against you personally. A loss is simply the cost of doing business in the markets. Nothing more, nothing less. The moment a trader genuinely internalizes this, not just intellectually understands it, but truly feels it at a core level, everything changes. The emotional weight of a red trade disappears. The panic response slows down. The urge to revenge trade fades. And for the first time, the trader begins to operate from a place of clarity rather than fear. Think about how any successful business operates. A retail store budgets for unsold inventory. An airline budgets for delayed flights. A restaurant budgets for wasted ingredients. These aren't failures. They are expected operating costs built into a profitable business model. And trading works exactly the same way. Every losing trade is simply an operating cost, a necessary expense that comes with running a disciplined, probability-based trading business. Once this mindset is genuinely adopted, two fundamental truths become permanently clear. First, following your edge correctly and still losing is not a mistake. It's probability working exactly as it should over a large sample size. Second, the only real objective in trading is never to eliminate losses. It's to consistently ensure that your wins outsize your losses over time. And the moment both of those truths are fully accepted, the turning point has arrived. From here, everything moves forward differently. So now that the turning point has been reached, now that losses are no longer personal, and the emotional weight of a red trade has been removed, what comes next? What actually separates a trader who has this awareness from one who consistently executes on it day after day, week after week, month after month? The answer is mindset, specifically the professional mindset. And it looks very different from what most retail traders operate with on a daily basis. The average retail trader measures success one trade at a time. A winning trade means today was a good day. A losing trade means today was a failure. Every session is an emotional roller coaster, driven entirely by short-term outcomes. And because of that, every decision gets colored by the result of the trade that came before it. A loss leads to hesitation. Hesitation leads to missed setups. Missed setups lead to frustration. And frustration leads right back into the emotional decision-making that loss aversion bias thrives on. It's a cycle that never breaks because the measurement system itself is fundamentally flawed. A professional trader operates on an entirely different framework. They do not measure success trade by trade. They measure it across hundreds of trades, across weeks, months, and full market cycles. They understand that any single trade is completely irrelevant in the context of a large enough sample size. A losing trade doesn't shake them because they know that one data point proves nothing about the quality of their system or the strength of their edge. What matters is consistent execution over time and letting the probabilities play out exactly as they're designed to.
And here's the most important part of the professional mindset that rarely gets discussed. It's not about being emotionless. Professional traders still feel the sting of a loss. They still notice the satisfaction of a winning trade, but those feelings never reach the decision-making process. There is a complete and deliberate separation between emotional response and trade execution. The plan was built before the market opened, and when the market opens, the only job is to follow that plan without deviation, without hesitation, and without allowing a single outcome to influence the next decision. That separation, that wall between emotion and execution, is what the professional mindset is built on, and it is what makes consistency not just possible, but inevitable.
So everything we've covered today comes down to this moment. The science has been explained, the pattern has been identified, the trap has been exposed, and the professional mindset has been laid out clearly. But awareness alone is never enough. Awareness without action is just entertainment. So here are 3 concrete rules that, when applied consistently, will permanently change how you respond to losses and transform the way you trade going forward. Rule number 1. Treat every loss as a business expense. Before you place a single trade, accept that losing is already part of the plan. Profitable businesses don't panic when operating costs arrive. They budget for them, absorb them, and keep moving forward. Your stop loss is not a failure. It is a planned expense that protects the overall business from a cost that could otherwise spiral completely out of control. The moment you begin treating losses this way, expected, budgeted, and emotionally neutral, revenge trading loses its trigger because you can't feel devastated by an expense you already planned for. Rule number 2. Focus entirely on execution, never on outcome. You cannot control where the market moves. You cannot predict with certainty what happens after you enter a position. The only variable completely within your control is the quality of your own decision-making. Did you follow your plan? Did you respect your levels? Did you execute without hesitation or emotional override? If the answer is yes, then the trade was a success. Regardless of whether it closed green or red, measure yourself by process, not by profit, and watch how quickly the emotional pressure of every individual trade begins to dissolve. Rule number 3. Respect your stop loss without a single exception. Not most of the time, not when it feels right. Every single time, without compromise. Because the moment you move a stop loss to avoid accepting a loss, you are handing full control back to loss aversion bias. That one decision, that one moment of hesitation, is what turns a $50 loss into a $500 catastrophe. The stop loss is not optional. It is the single most important risk management tool you have. Protect it like your account depends on it, because it genuinely does.
So here we are. Everything has been laid out in front of you. The science behind loss aversion bias, the pattern that traps traders at every level, the professional mindset that breaks that pattern permanently, and the 3 rules that put it all into daily practice. You now have more clarity on trading psychology than the majority of retail traders will ever develop in their entire trading careers. But knowledge without application means absolutely nothing. The traders who transform their results are not the ones who simply watched this video and moved on. They are the ones who took this information, internalized it deeply, and made a deliberate decision to trade differently, starting from their very next position. That decision starts right now, with you. So here is the only question that matters. Will you continue allowing loss aversion bias to silently control your decisions? Or will you finally draw the line, apply what you've learned today, and begin operating like the professional trader you are fully capable of becoming? Drop a comment below and tell us honestly, what hurts more, losing money on a trade or missing a move you saw coming but never acted on? I read every single comment, and I genuinely want to hear where you are in your trading journey right now. If this video added real value to your trading mindset, hit the like button, subscribe for more trading psychology and risk management content every week, and share this with one trader in your circle who needs to hear it today. Because the market will always be there. The real question is whether your mindset will be ready for it.